venture capital, it's like sometimes it feels like you're trying to predict earthquakes, these like bursts of intense activity, and then things go quiet. And it's like, how do you even wrap your head around it?
It's tough.
Especially if you don't want to like spend all your time getting lost in the weeds.
Yeah.
So we're going to cut to the chase for you and dive straight into a pretty major shift that's happening right now.
Yeah, we're going to focus today on this real evolution we're seeing in the venture capital industry, like something that's beyond just the normal ups and downs of the market, right?
Right.
So to really break this down for you, we've pulled together some really insightful stuff, discussions with prominent figures like Bill Gurley, Howard Marks, plus some academic research on how startups get funded and how that whole innovation engine works.
Exactly, yeah.
So our mission for you in this deep dive is to kind of unpack all of this. Like, why is this happening now? What does it really mean for investors? What does it mean for the kinds of companies that are getting funded? Get ready for some surprises along the way, and hopefully a few of those aha moments where everything clicks into place.
Okay, let's get into it.
So to really understand where venture capital is going, it's actually helpful to look back at how it's traditionally worked.
Right.
There's this idea of a relay race that's often used to describe this whole process.
Right.
So you'd have different venture capital firms, different VCs, investing in a company at different stages as it grows. And it's kind of like passing the baton, right, to the next set of investors as the company matures and needs more and more capital.
Like graduating to the next level.
Exactly, yeah.
But it sounds like there's a bit of a critical take on this traditional structure. Bill Gurley, in a conversation he had with Howard Marks, talked about how Marx just flat out called the venture industry a really shitty industry.
Wow.
Yeah. And when Gurley asked him to explain, why he felt that way, Marx's response was pretty blunt. He said, cyclical collapse is built into the structure. I mean, that's a pretty stark statement.
That is, yeah. It really highlights this inherent instability that's always been part of the venture world.
Right.
And, within that traditional landscape, you have firms like Benchmark, who kind of set a certain standard. Their approach was all about running these relatively small, really tight focused funds. They built close, almost like personal relationships with the founders they backed and were really laser focused on delivering strong returns. So it was all about efficiency and deep connections.
Okay, and then we see this emergence of a very different approach. Probably the best example is Andreessen Horowitz, right?
Yeah.
A16Z.
Yeah.
And their whole philosophy is kind of the opposite. It's built around this idea of capital as a competitive advantage.
Yeah.
What does that actually mean, though?
Well, I think what's really interesting is this fundamental change in mindset, right? So instead of that focus on efficiency and smaller funds, the capital as a competitive advantage model embraces these much larger funds, and they really put an emphasis on scaling quickly, like rapid growth is the goal.
Okay.
It's about deploying huge sums of capital to fuel this growth, often using things like digital marketing and taking advantage of the low interest rates we've seen in recent years. And crucially, it also involves a lot of investment in building a powerful brand and creating a really big platform to support all the companies they invest in.
It's kind of like they're not just investing in the companies, they're investing in this whole ecosystem around them.
Exactly, yeah.
And that brings up some of the concerns that Bill Gurley has been pretty vocal about. He's worried about just the sheer amount of capital firms like A16Z are putting into the market.
Right.
The concern, and a lot of people share it, is that this massive influx of money could actually be artificially inflating these company valuations.
Right, it's like a bubble waiting to burst.
Yeah, potentially setting the stage for another tech bubble. And there's some numbers that really illustrate this, like the number of U.S. startups reaching that billion-dollar unicorn valuation, shot up to like 38 in a recent year compared to just 23 back in 2013. That's a huge increase in a pretty short time.
Yeah, it definitely shows how much capital has been flowing around.
And I guess because of these worries, we've seen a lot of VCs telling their portfolio companies, hey, raise as much money as you can right now.
Yeah, it's like stockpiling for a rainy day.
Exactly. Build up that cash reserve to weather any storms that might be coming. So we have these two distinct approaches. The traditional, smaller, founder-focused model, and this newer, larger strategy that's all about scaling fast. But it sounds like this difference has created some real challenges, especially for venture firms that are just starting out, the newer kids on the block.
Yeah, the greener GPs. That's like industry slang for general partners at new venture capital funds.
Right, greener GPs.
And this is a really important point to understand because these newer firms, they often try to take bits and pieces from both models. Like they see the success of Benchmark, they see the success of Andreessen Horowitz, and they think, okay, we can just do both. But the problem is they don't have the massive capital that a firm like A16Z manages, or the long track record and the discipline of a benchmark.
Right, so they're kind of stuck in the middle.
Yeah, they can find themselves in a really tough spot. And what happens is it leads to this kind of muddled thinking about some of the core things in venture investing. Like, what's the right entry valuation? What's a realistic valuation down the line? How concentrated should our investments be? It's a lot to juggle without a really clear strategy.
Okay, so we've got the traditional VC model and this newer, larger scale approach.
Yeah.
But our sources talk about how this is all leading to something called the venture bank model. And this is being driven by firms like Andreessen Horowitz. And it's presented as not just a different investment strategy, but like a whole new type of financial institution.
Right, and that's the key thing here. It's not just competition. It's a total rethink of what a VC firm is and what it does.
Okay.
And the roots of this go back to the aftermath of the 2008 financial crisis, like the dot-com boom. You saw these big, established firms raising these huge funds, over $1 billion. And entrepreneurs like Mark Andreessen and Ben Horowitz, they'd been there, done that, built companies, and they saw this opportunity to basically revolutionize the VC model.
So how did they actually go about building this venture bank model to achieve that scale? I mean, it sounds like it was more than just raising bigger funds.
Oh, absolutely. They had this multi-pronged strategy. Like, a big part of it was pouring money into media, creating content, building a really strong brand name within the tech world and in the wider investment community. They wanted to be a household name. And they also worked hard to create these network effects, using things like their scout programs and their accelerator platforms. This helped them find more potential investments, bring more talent into their orbit. And then on top of that, they built out these big platform teams, like internal groups of experts who could offer all kinds of support to the companies in their portfolio.
Okay.
It's what our source calls a boom loop. Raise capital, maximize exposure, create perceived winners, and then raise even more capital based on that track record.
And you can definitely see this in Andreessen Horowitz's fundraising success. The numbers are pretty mind-blowing. They raised over $14 billion in new funds in just the first half of a recent year.
Wow.
Which was almost as much as they raised in the entire 3 years before that.
Yeah.
And even when the overall venture funding scene cooled down, dropped by like 50% from its peak, they still managed to raise another $7 billion.
It's amazing how resilient that model has been. Like, while the broader VC market took a hit, these big venture banks, especially the top 10 or so, they kept attracting most of the available capital.
Right. And of course, this has created some frustration for smaller firms, the greener GPs we talked about. They're finding it hard to compete for deals, and they're struggling to raise their own funds.
Yeah, so it's almost like a self-fulfilling prophecy in a way.
Kinda, yeah.
So where's all this money for these venture banks coming from? It seems like there's been a shift in who their limited partners are, the people investing in these funds.
Yeah, this is really important. They've moved away from relying mainly on those high net worth individuals and family offices. Now they're targeting much bigger, more patient investors. Think like major pension funds, university endowments, and especially these sovereign wealth funds, those state-owned investment vehicles.
What's the logic behind that, though? What's the appeal for these huge long-term investors?
Well, there's a few key things. The sheer size of the assets managed by these venture banks means they can potentially offer more stable, predictable returns over the long run.
Right. Which is really attractive to institutions that are thinking long-term. They can also invest across a much wider range of asset classes, so more diversification opportunities. And of course, having that big, recognizable brand name brings a certain level of prestige and perceived lower risk.
It's almost like they're becoming too big to fail in a way.
Kind of, yeah.
Okay, and then there's this concept that our source brings up about these venture banks farming innovation beta rather than hunting alpha. Can you break that down?
Yeah, traditionally, venture capital has been about identifying and backing those specific high-growth companies, the ones that are going to outperform the market, the alpha.
Right.
But farming innovation beta is much broader. It's about gaining exposure to the overall growth and trends in tech across all stages, from early-stage private companies to public stocks, and even into things like tokenized assets. It's less about picking winners, more about capturing the overall upside of innovation.
So it's kind of like investing in a whole index fund of technology rather than trying to pick the next Apple or Google.
Exactly, yeah.
And this scale gives them a lot more flexibility in how they operate, especially when it comes to providing liquidity or the ability for their investors to cash out.
Yeah, their size means they can use all sorts of mechanisms to generate returns and give their investors their money back. Things like participating in secondary markets, setting up continuation funds, distributing shares of public companies, even dealing in crypto assets. So they're not as dependent on IPOs, and they can afford to wait out bad market conditions.
So it's like the old saying in venture capital used to be in the right place at the right time, but this is more like be everywhere all the time.
That's a great way to put it.
But this shift also creates an opportunity for the more traditional VC firms, doesn't it?
Potentially, yeah.
If these venture banks are focused on these massive institutional investors and these broad themes, what happens to the smaller players?
Well, there's a chance for kind of rebalancing here. With venture banks catering to those big LPs and focusing on mainstream themes, there should be less competition for capital from the traditional limited partners.
Once they come back, right, once they get their appetite back for
You're
venture.
right, exactly. And this means smaller firms really need to focus on finding and investing in non-consensus themes, which some would argue is what they should have been doing all along.
Right, like finding the hidden gems, the truly disruptive ideas that the big guys might miss.
Exactly, yeah.
And it sounds like the way limited partners choose VCs might also need to change.
Absolutely. Getting access to those really hot deals might become less important for LPs because the returns from those individual deals might not be worth the effort, especially for the really big LPs.
It's like the juice isn't worth the squeeze anymore.
Yeah, exactly. And instead, the focus could shift to what's called evergreen investing theory, which emphasizes diversified portfolios that can capture those rare, huge successes while managing overall risk, and using really solid, systematic processes for finding and evaluating investments that minimize bias, what's called process alpha.
Okay, so Process Alpha is like having a repeatable, rigorous system for finding good investments, not just relying on personal connections or what's trendy at the moment.
Exactly, yeah.
So could all of this actually lead to a healthier venture capital ecosystem?
That's the hope.
I mean, the source even talks about it becoming more of a positive-sum game that truly fuels innovation, rather than something that looks like a Ponzi scheme during those times of hype and speculation.
Right. The idea is that by moving away from just chasing the hottest trends, VCs will have to get better at understanding the real value in new early-stage ideas.
And this could also help correct a historical imbalance in where venture funding has gone. Our source points out that so much capital, especially in Silicon Valley, has been directed towards those consumer-focused startups, often at the expense of potentially more impactful projects in areas like deep tech and hardware.
Yeah, and a big reason for that is this widespread use of ARR, annual recurring revenue, multiples for valuation. And this method really favors those subscription-based businesses in the consumer internet space. It's much harder to use that for deep tech and hardware companies, which have different revenue models and take longer to develop their products.
And Bill Gurley warns against relying too much on those price-to-revenue ratios for valuing companies. He actually compares it to the internet bubble of the late 90s, saying all revenues are not created equal.
That's a good point. As VCs get better at understanding real value, the exit opportunities for startups should improve too. The focus might shift away from just growing revenue as fast as possible to metrics that show overall financial health and sustainability.
So it's not just about growth at any cost anymore.
Right, it's about building solid companies for the long term.
And this could mean more of that long-term value created by these companies ends up being available to regular investors, what's called mass market retail participation, rather than just being concentrated in the hands of private investors for years. So looking ahead, our source really emphasizes that 2025 is going to be a pivotal year for venture capital. They call it a crucible. And there's this gap right now between the level of exits, companies being acquired or going public, and how the public markets are performing. Plus, overall confidence in the sector is kind of low.
Yeah, that's a fair assessment. But there is a potentially positive sign. We're seeing more interest in smaller venture firms raising capital.
Okay.
And this actually lines up with historical patterns where smaller firms tend to see more activity about a year after the bigger established firms lead the way.
So the question for those smaller firms is, how are they going to navigate this? Will they learn from the past 5 years and use their strengths, their agility, their focus on niches, their ability to do deep dives in specific areas? Or will they keep trying to compete head-on with the big venture banks and their risk appetite and their scale?
That's the challenge, right? It's all about finding their niche and playing to their strengths.
Exactly. So to wrap things up for you, we've explored this big shift in venture capital, the rise of these venture banks, the challenges and opportunities that creates, and what it could mean for innovation and the whole tech ecosystem. Hopefully this gives you a good understanding of what's going on without having to get lost in the details.
Yeah, it's a lot to take in, but hopefully it helps make sense of things.
And to leave you with a final thought, in this landscape where there's so much money going after those big tech trends, what unique strengths does a smaller, more focused venture fund have? Could a contrarian strategy, investing in overlooked sectors or different types of businesses that aren't all about hypergrowth, be the key to success in the coming years? Think about what that means for the kinds of innovation that get funded and the direction the whole tech industry takes. Thanks for joining us on the Deep Dive.
It's been a pleasure.